Right, last week we went through IAS SWOT 12, which is on current tax and deferred tax. Right, what we'll do today, we are going to try to apply what we learned last week. We are going to do a question which will require us to calculate deferred tax and current tax. You want to see how far we are going to go, or we want to test our understanding. But before we do that, let me just do the recap of what we covered last week. I do understand the topic is a bit challenging. Right, IAS 12, what did we say last week? We said the standard is to do with calculation of current what? Current tax or current taxes, and the calculation of deferred tax. Deferred tax, which is future tax. Right, how do we go about calculating our current tax or current taxes? We said our departure point is profit.
Before tax.
Right, profit before tax. Thank you so much. Profit before tax, that is our departure point. Then after getting our profit before tax, we adjust it for what is called exempt differences. Exempt differences. What are exempt differences, or what are the elements of exempt differences? We said we have taxable incomes and the non-deductible expenses. Yeah?
Yes.
You are now thinking of tax 2601. You are now thinking of tax 3701. Now you have to factor in tax. You are adjusting your profit before tax so that you get taxable income. Right. Example of non-taxable items or exempt items, we have dividends. Né?
Yes.
We have what? Dividends. That is dividends received. Right. What else do we have? We have foreign income. Foreign income, the reason why we exclude it, it is because of double tax what? Agreement between countries. Foreign income received. Right. What are we doing with this? They are included in profit before tax, so we need to take them out because they are non-taxable. Right. What else do we have? We have profit on sale of assets, that 20% profit on sale. Other sources, they call it what? Capital portion on assets, where you are going to say your selling price minus the cost of the asset, then it times what? 20%. Note that you only have this one provided the asset was sold above the original cost price, or provided the asset is sold above the original what? Cost price. What you are doing here, you are just adjusting for capital gain. Remember, capital gain, the inclusion rate is 80%. So the other 20% is not taxable. So we're taking out this 20%. What else? Right, as for income, I can go as far as these three. Then let's think of expenses which are non what? Deductible. Yes. What we have? We have fines. Yeah?
Yes, and
we have
penalty.
fines. So we need to add them because they are non-deductible. One will simply say they are prohibited in tax. We again we have interest, especially interest on what? Interest on late payment of tax. Right, interest, let's just say interest. Here we're not talking of financial cost as in the normal interest on loan, no. We're talking, let's say interest on late payment, so that you don't get confused. Interest on late what? Payment. Yeah. Remember, it's an expense, so we need to add it back. What else do we have? Things such as legal fees. Yeah, legal what? Legal fees. Or when you say legal fees and fines is one and the same thing, it's fine. It's one and the same thing. It depends on the terminology being used in the what? It depends on the terminology being used in the question. Then what else? Donation. Sometimes you can have donation. Remember, in tax, donation is limited to 10% of taxable income. Or again, a donation should be to a public benefit organization, but in accounting, we don't consider that. So a donation again can also be part of exempt difference there. What else? I'm trying to think, right? You can also have depreciation on admin building, right? This one would depend on whether SARS is subjecting the admin building to capital allowances or not. If they say SARS does not allow capital allowances on admin buildings, then you are going to include depreciation here and add it back. Or they say admin building is exempt at initial recognition, right? We're going to look at that paragraph. This can also be part of exempt differences. Just know that there's the possibility of having depreciation on admin building. I've seen this one now and then. Then after that, we have now our taxable profit after exempt difference, or one we call it profit after exempt difference. Profit after exempt differences. Right, we put our profit here. Then after this, we calculate what is called movement in temporal difference. Movement in temporal difference. We talked about temporal difference last week. We said the temporal difference is a result of what? Right, temporal difference. You get it when the carrying amount of an asset, blah, 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 carrying amount of liability. You still remember the whole composition which we did look at last week. Right, you can add or deduct, you can add it or subtract it. I'll explain when we add it and when we deduct it. For now, let's just say we have temporal difference. Then after that, let's assume we're subtracting it. Then after that, now you have your taxable income. You have your what? Your taxable income. Right, you calculate your current tax now on taxable income. Current tax on what? On taxable income. Yes. All right, going further, you are going to see that we are also going to add what is called assessed loss. Yeah? We are going to have a situation whereby assessed loss is going to reduce our taxable income. And again, we are going to include provisional tax. Provisional tax will reduce your taxable, or will reduce your current tax. But for now, let's just end on taxable income and say our current tax is calculated on what? On taxable income calculated in this manner. Yeah? Right, then after that, we looked at deferred tax. We looked at what? We looked at deferred tax. What did we say on deferred tax? We said this animal is calculated on temporal difference. I'll just use TD. Ne? We said this animal is calculated on TD, which is temporal difference. Right, now, as for temporal difference, we said we have a deductible, and taxable temporal difference. Huh?
Yes.
Taxable temporal what? Difference. Deductible, we said this will give rise to a deferred tax what? Deferred tax asset. Ne?
Yes.
Then this one will give rise to a deferred tax liability. Right, that's what we say. Right, I'm not going to go into much detail. We covered this. I'm just trying to summarize. We did cover it last week, and there's a recording on it. All right, then how do we calculate deferred tax? We said we use the statement of financial position method, whereby you have a table like this. You have your carrying amount, you have your tax base, you have your temporal difference, then you have your deferred tax asset or liability. Liability should be in brackets like this. Right, one will say, what exactly are the items that give rise to deferred tax? Right, I will simply say you need to look for items which are part of the statement of financial position. Right, we need to look for items which are part of the statement of financial position. Remember, in the statement of financial position, we have assets and liabilities. So assets which are treated different in accounting and assets which are treated different in tax, they will give rise to what is called deferred tax. Altogether. For example, in tax, we have capital allowance. Then in accounting, we have depreciation. You discover that the depreciation rate and the tax allowance is totally different. In text, we talk of manufacturing assets. On manufacturing assets for small business corporations, we claim allowance at 100%. Then in non-manufacturing assets is 50, 30, 50, 30, 20. Then again, we talk of manufacturing assets of not SBCs, where we claim allowance at 40, 20, 20, 20. But in accounting, we don't do that. So that difference in treatment, or that difference in calculation of depreciation and the capital allowance will result to deferred tax. So you discover that the majority of items that give rise to deferred tax are the elements of the statement of financial position. You have, let's say, your assets. Let me just think of common items like machinery, delivery vehicle. That is if depreciation and the capital allowances are calculated different. Out again. Right, then we have things such as revenue received in advance, revenue received in advance, or income received in advance, income received in advance, right? Income or revenue received in advance. In accounting, remember what you do is you are going to debit what bank. If you receive revenue in advance, you debit what? You debit bank, then create what? One you say contract liability, or one you say income received in advance. By crediting it, we are recognizing what? A liability. We, in accounting, you debit bank, then you credit what? Credit a liability, meaning that liability is going to be there in your statement of financial position. But in tax, we don't do that. In tax, we include the whole amount of gross income. You receive revenue in advance today. We'll say this is total gross income received during the current year of assessment. You have to go back to the gross income definition. You include your revenue received in advance, and it is going to be taxed in the current year. So you discover that we have revenue received in advance, having the carrying amount, having the what? Carrying amount, but the tax base is going to be zero. Reason being what? The reason being in tax, we included the year we receive it. Right. And then what else? I'm trying to look for the common items here. Right. We also have credit loss. We also have what? Credit what?
Credit loss.
Loss. Yes. Or one you say allowance for what? You know the term. Credit loss. Right. When it comes to credit loss in accounting, we have our own rate. Let's say our credit loss is maybe 20% of our debtors, or they'll say credit loss 50,000. In tax, credit loss is at 25%. So you discover that in accounting, we have an amount which is different from the one which is in tax. Tax is 25%. Unless now, if you want to go deep and say, okay, in tax, we have to check whether the entity is using IFRS 9 or not. If it is using IFRS 9, it is going to be 40% of the debtors more than 60 days, then and so forth and so forth. But just know that here you are going to see 25%. In tax, we'll calculate our credit loss at what? 25% of our total debtors. But in accounting, we'll use a different rate. So you have a situation whereby on credit loss, we are going to have a what? A temporal difference, right? Why? Because the rates which are used are totally what? The rates which are used are totally different. What else? What else? Right, we also have a prepayment. Prepayment, remember, we're talking of a prepaid expense. On prepayment here, we're talking of a prepaid expense. What's the story when it comes to prepayment? In tax, remember, we have to check whether the prepayment is for a period more than 6 months, or is for a period, for the amount is more than 100,000. Or let me just say, when it comes to tax, we deducted prepayment, right? For simplicity's sake, the detail, we are going to get it in tax, or the detail, we are going to apply it in what? In tax. So if ever there's a prepayment, we're going to have carrying amount. But as for the tax base, it's going to be zero. Why? Because we deducted the expense in the year in which you also accrued or incurred. That's what we do in tax. Right, then again, we have what is called assessed loss. Assess the loss, we're still going to look for it. An assessed loss is a tax concept. So the carrying amount of assessed loss is always going to be 0, but the tax base will be the amount of assessed loss, giving us a temporal what? Giving us a temporal difference, which will give rise to a deferred tax asset, which will give rise to a deferred tax asset. Right. So that's what we covered last week. That's what we covered last week. The calculation of deferred tax and the calculation of current tax. Our deferred tax being calculated on temporal difference, and our current tax being calculated on what? Taxable income. So what I want us to do today is to do a question. This question is last year assignment for FAC 3701. Right, let's do this assignment together so that you'll be able to try questions on your own. Right, let's see the required of this question. Right, let's go to the required. OA, they are saying prepare the necessary journal entries in the accounting records of Brick Block Ltd to correctly record additional information 6 for the current year, 31 December 2022. I'm not interested. We're not going to attend to this one. Disclose the income tax note, including tax reconciliation, in the notes to the annual financial statements of Brick Block Ltd for the financial year ended 31 December 2022, according to the requirements of IAS 12 income taxes. Right here, we are required to disclose income tax note. Your income tax expense is made up of current tax and deferred tax. There is no way you disclose this without calculating what? Your current tax. So I want us to calculate current tax here and deferred tax. So let's start with the calculation of what? Current tax. What's the name of the entity? It's right, timeline first year end is 31 December 2022, meaning beginning of the year is 01 2022. Yeah? Right. Calculation of current tax. Calculation of current tax. Calculation of current tax. Right. Right. What is the departure point? Our departure point is profit before tax. Profit before tax. That is our departure point. We only need 2 columns. Fine, like this. Right, now let's go to the information. Unfortunately, sorry, I did not share this with you. Just follow. I'll share it after class. They are saying to us, Brick Block Ltd is a manufacturer and retailer of clay bricks and cement blocks. The following information of Brick Block was presented to you for the financial year ended 31 December 2022. Brick Block, right, statement of profit and loss and other comprehensive income. Right, we're given sales up to profit before tax. Our departure point, good people, is profit before tax. So we want this amount. That's what we want first. Profit before tax is given 8,250,000. We have 8,250,000. This is our profit before tax. Then we go to exempt differences. Exempt differences. You are simply saying in this profit, we have to take out incomes not taxable and add back expenses not deductible. Let's read through. Right, then you are given our profit before tax, there it is. Right, additional information. These are just line items. They're not going to do anything. They don't mean anything. They are just numbers. So we need their breakdown to know what is included in profit before tax, which is supposed not to be included, and so forth. Additional information, other income. The following items are included in other income. Other income line item is this. The following items are included in other income. Dividends received from listed investment amounting to 80,000. So these dividends are here. They are also here. They are exempt. It's an exempt income. Go there, write dividends received, 80,000. Dividends received. How much? 80,000. You are taking them out. They are not taxable. Remember, these are dividends paid to a company. Local dividends are exempt. That's the rule in tax. Local dividends are what? As they are exempt. Right. We move on. The annual rent is receivable on 1 July every year, and the following amounts were received from investment property owned by Brick Block Ltd. Right, we own a property. We own investment property. So from this property, they are saying to us, annual rent is receivable on 1 July every year. Remember, our year end is what? Our year end is 31 December. Now they are saying we'll receive annual rent on 1 July every year. On 1 July, we receive rent for 12 months, meaning what relates to the current year is only rent for 6 months. The other 6 months is income received in advance. You understand? The annual rent is received in July every year. Here, we're going to receive annual rent for 12 months. These 12 months are going to end in the next financial period. So we're going to receive rent in advance for only 6 months. You understand this?
You're breaking.
I'm breaking. Right, how about now? They are saying the annual rent is receivable on 1 July every year, and the following amounts were received from investment property owned by Brick Block. Meaning, in July, we're going to receive rent for next year. We're going to receive what relates to current year is only for 6 months. What relates to the next year is 6 months. So rent received in advance is what? Is also exempt.
Exempted.
You understand this one?
Yes, yes.
Rent received in advance is also, what do we do? All right, let's take it this way. Let's take it this way. What do we do with the income received in advance in accounting? What do we do with income received in advance? Right, we have received the rent in advance. What are we going to do? Let's see. We are going to debit bank, right? Right, so current year we received 60,000. Our year end is how much? So let's see. Our year end is 31 December 2022. This one, all right, this one. We received 72. We received what? 72,000. We are going to debit 72,000, right? Of this 72,000, what is going to go to other income? Other income is half of it, which relates to 6 months. The other 6 months is prepayment. Half of this is how much? 72 divided by 2.
36.
It's 36. Then the other one is going to be rent received in advance. Rent received in what? In advance, 36,000. This one is a liability. Right, so this 36,000 is going to go to the statement of financial position as a liability, which will give rise to deferred tax. In the income tax, in the profit before tax, we only include 36,000. It's fine. Accounting treatment is okay. Then in tax, what we are going to do, we are going to include the total amount 72,000 in what? In gross income. So therefore, how much did we include here in other income from rent? We only included 36,000. So it's not going to affect profit before tax. It's fine. It will only give rise to deferred tax. How much of it is going to give rise to deferred tax is what is received belonging to the next what? Financial period. That is 6 months. Not going to affect. Then profit on sale of machinery amounting to 380,000. Profit on sale of machinery amounting to 300 and what? 80. What did we say about this one? We said if the sale of an asset, if the selling price is greater than the what? The cost, then we have to take out 20% of what? Of the selling price minus what? Cost. Now we have to establish the selling price and we have to establish the what? the historic cost. What they gave us here is the profit. We are not interested in profit. We are interested in the selling price and what? And the cost. They referred us to note number 3. Let's go to note number 3. On 1 January 2020, a brick sold a brick manufacturing machine for 800. Selling price, 800. On this date, the carrying amount and the tax base of brick manufacturing machine amounted to 420 and 360 respectively. We don't need this for now. We need the original cost price. The original cost price of the brick manufacturing machine at acquisition it amounted to 600. So historic cost price is 600. Historic cost price is how much? Is 600.
600.
Right, now, do we agree that we sold this asset above its historic cost price? Do we all agree that we sold this asset above its historic cost price? Yes. So now we need to deduct that 20%. We're going to come here and say 20%, or one to say sale of asset or capital gain. I prefer to say sale of asset, right? Selling price is 800, cost is 600, then times 20%. Can someone calculate it for us? That is 200 times 20%, 200 times 20%, that's 40,000. Eh? We take it out. Why? Because capital gain, the inclusion rate is what? Is 80%. When it comes to sale of assets, in tax we account for capital gain. The inclusion rate is 80%. But here they included the total gain. We're simply saying 20% of the gain should not be included. That's what we're saying. Right, then we move on to the next item. Foreign income amounting to 190,500. What did we say about foreign income? They said refer to note number 4. During the yes, is exempt. But now you have to be sure that there is double tax agreement, or you have to be sure that that foreign income paid foreign tax in what? In another country. Because if it paid tax in its original country where it's coming from, taxing it again in South Africa is going to be double tax. So therefore, that's why it's exempt. It can also be there's a double tax agreement. So let's hear the story. During the current financial year, BRICS received income amounting to 190 from Canada. That is not taxable in South Africa. They have said to us it's not taxable in what? In South Africa. So no need to go further. Let's just take it here. It's not taxable in South Africa. So let's go deduct it. 190, 500. We have minus foreign income. Foreign income received 190, 500, like this. We're taking it out. Right, we move on. Remember, it's note by note. Other expenses. The following items are included in other expenses. Depreciation for the year on machinery amounting to 405. No problem with machinery, we depreciate it, we claim capital allowance, it will be, this will only, we'll take this into consideration when it comes to deferred tax. Legal fees amounting to 60,460 that are not deductible for tax purposes. They are saying they are not deductible for tax purposes, but for in accounting, we deducted them. Let's go at them back. Legal fees, 6,400. Legal what? Legal fees. Why are we adding them back? They are not deductible. So we add them back. Right, then we continue. Let's go, Lana. Right, interest paid on late payment of provisional tax. This one is prohibited in tax. Tax is charging you interest on late payment and you go deduct it again. It's good as you are saying to them, you are crazy. This expense which you gave it to me, I'm going to take it out from the income. It's prohibited. So the accountant deducted this tax saying, no, we're not, you thinking we are crazy, né? So interest paid. Interest paid, we said how much? 10,200, add it back. 10, 200. Then we move on. Property, plant, and equipment. We are now on assets. We have dealt with income and expenses, people. We have dealt with income and what? And expenses. Now we are on assets. This will affect what? This now is going to affect the what? The statement of financial position. So therefore, we expect deferred tax from these other following what? We expect deferred tax from these following transactions. So as for exempt differences, we can now calculate the total. Let's add. Right, our total, we are going to put it here. Remember, we want exempt difference. Minus 800 plus minus 400 plus minus 190, 500 plus 6460 plus 10, 200. Right, do the calculation for me. I'll give you 30 seconds to do it. Right, Alpha?
Minus 239790.
Minus 23.
979. I'm not sure if it's correct.
Others will confirm 23 what? 9
239790.
790.
90.
Right. Are we all getting the same amount? Right. I know the issue there is on the side. Just take the numbers as they are and punch them in the calculator. Minus 80,000. Minus 88.
40. Yes, 80 minus 40 minus 190, 500 plus 60, 460 plus 10, 250. Is it?
I got it to 239,840.
239,840. Someone else?
Interest paid, what is it? It was 10,200. Oh,
10,000.
yeah, I said 10,250. That's why it
Yeah,
makes
it's
sense.
840. I'm also getting 840.
Yeah.
Right, it's negative now.
Yes, it's minus.
Right, so now we will have our profit after exempt difference. Profit after exempt difference, or taxable income after exempt difference. After exempt what? Difference. How much? You are going to say 8,250 minus 239,840, giving us how much?
8,010, 160.
160.
Yes.
Right, then after that, we say movement in temporal difference. Movement in temporal what? Difference. Let me just TD. Right. Now I'm going to explain this thing of movement in temporal difference. How you add it or subtract it, or when do you add it or subtract it? If you get a deductible temporal difference, if it is deductible, you deduct it. And then if it is taxable, you add it. Again, if it is deductible, you subtract it. If it is taxable, you edit, right? But now, this now will force us to go to the calculation of deferred tax. For us to get the movement in temporal difference, we now have to do the calculation of what? Deferred tax. You discover that these calculations, you do them concurrently. You cannot do the calculation of current tax and say, I'm done with it, without doing the calculation of deferred tax. Right, so carrying amount, tax base, temporal difference, then deferred tax, asset or liability in brackets. Right, remember we're doing for 2022. For us to have movement in temporal difference now, we have to do for 2 years. We need to calculate deferred tax for 2021 and deferred tax for 2022. So we're going to start with 2021. We are going to start with 2021, right? Right, back to our information. Now we're looking for items that give rise to deferred tax. Right, one of the items which we identified, which is also included there in our income, is the income received in advance. You remember that income received in advance. Let's start with income received in advance before we jump to our assets. There is
Are you still there? You were quiet. I think he lost the connection, boy.
Okay.
It says, I'm now the host.
Yeah, carry on listening.
okay, good people. I lost connection. I'm back. Are you still there?
Yes,
Welcome
we can
back.
hear you.
Waiting for
Good
you.
people? All right. Well, what did we lose each other? I was on which point?
Where we calculating the
Asking
deferred
about
tax?
income received in advance.
Yes.
All right, yes. Income received in advance, we said it's a liability which will give rise to deferred tax. Why? Because in tax we include it in gross income when it's received. Then in accounting, we have to take what relates to the current year and what relates to the next year. In accounting, remember, we apply a matching concept. So in 2021, we received 60,000 on 1 July, which is for 12 months. What is for 2021 is only half of this. 60,000 times what? 6/12. And income received in advance again is for 6 months. So we have income received in advance of how much? 30,000. Or one can come here and say income received in advance or rent received in advance. How much? 60,000, 30,000, sorry, because it's 60,000 total, then share it equally. And then in tax base is 0. Why is it 0? It is because in tax we included it. In 2021, we included the full amount in our gross income. So this is a liability. This liability is having a carrying amount of 30,000 and the temporal difference of how much? Of 0. So carrying amount of a liability is greater than its tax base. It will give a rise to a deductible temporal difference, which will give rise to a deferred tax asset. But now we did not check the tax rate. What is more important is to read it through and to read through your information, find the tax rate, etc. They say the SARS normal tax rate is 28% and remained unchanged for the past 3 years. The inclusion rate for capital gain is 80%. The dividend tax is what? 20%. So our
20%.
tax rate is 28%. So we're going to use 28% here. So 30,000 times 30%, how much is it? 30,000 times 28%.
Mm.
3033 times 0.28. Good people.
8,400.
8,400. It's an asset. Why is it an asset? The carrying amount of a liability is greater than its tax base, giving us a deductible what? Temporal difference. Right. We're fine with this one. We move on to the next item. Right. From the income and expenses, that's what we identified. Right. From income and expenses, you have to look for income received in advance and prepaid expenses. Income received in advance is a liability. Prepaid expenses is a what? Is an asset. There is no prepaid expense. We did not identify any prepaid expense here. Did we? No. Right. So we go to our assets. The first asset which we have is property, plant, and equipment. We have property, plant, and what? And equipment. Let's hear the story on property, plant, and equipment. On 1 January 2022, Earl sold brick manufacturing machine for 800. On this date, the carrying amount and the tax base, right? It was sold in the next financial year. For now, we want information relating to 2021. The cost and carrying amount and the tax base of the remaining manufacturing machine, excluding the brick manufacturing machine, on the respective financial year end 31 December were as follows. Right? We are given the assets here. Cost in 2022, 2,700,000. Carrying amount is given. Tax base is given. 2021, we are given again the carrying amount and the tax base. What do we want? We want the carrying amount and tax base. So we just take the amounts given. No need to adjust them. They are already calculated for us. But it's not always the case. Sometimes you need to what? To calculate them. Is it clear? So the carrying amount is 1,890,000, tax base 1,620,000. Right. We say what? Machinery. Or if you want, you can write PPE. But if there are more than one, you have a problem. Machinery. We say it 18 what? 1890, eh? And 1620. All right. Carrying amount is 1,890,000. Tax base is 1,620,000. How much is our temporal difference? Kindly calculate. How much is it? 1,890,000 minus 100, 1,620,000.
270.
270. The carrying amount of an asset is greater than its tax base. It will give us a taxable temporal difference, which will give rise to a deferred tax liability. 270 times 28% times 0.28. Two 70 times 0.8. How much?
7,500.
7,500. Right, we're done with this one. We move on to the next one. Right, no machinery was acquired or sold during current year. Then foreign income. Foreign income during the current financial year received, we dealt with this one. Current assets, included in current assets, the statement of financial position as at 31 December is a prepaid insurance, right? They are saying we have a prepayment. It's going to result to deferred tax, but they are saying in 2000 and what? In 2022, not in 2021. Then BRIC declared dividends. This has to do with what? Dividends. This has to do with what? Dividends. Dividends do not affect. Right, then what are they saying? Yes. On January received tax, which reflected amount of 800 as the assessed taxable income. The current tax expense disclosed in the statement of profit and income amounted to. The difference arose as paid the tax under the current financial year, blah, 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 BRICS, made the provisional payment of this. Then they're saying the total deferred tax in the statement. Right, we are fine. Any asset which we left out, we took this into account, we took this into account. There was that one which was sold. What did we do with it? We adjusted it. Right, that's all. Any other asset any other information which we did not consider here? Is there any other information which we did not take into account?
Other expenses.
No. What? Other expenses? Other expenses, what you want for deferred tax is a prepaid is a prepayment. There's no prepayment here. Altogether. There's no what? Prepayment. Right, so we are fine. Now we move on to 2022. We move on to what? 2022. Right, we can use the same table, but what we have to do now is to say 2022. But you are going to get confused. Let me repeat it. Carrying amount, tax base, temporal difference, then deferred tax. Right, let's go. All right, starting from income, we have, right, we now know people. Even in 2022, we still have rent received in advance. Rent received in what? In advance. Received in advance. How much of it? In 2022, it was 72,000. 72,000 times
36.
36, ne? 36,000. Then in 36,000 in brackets, giving rise to deferred tax. 36,000 times 28. 36,000 times 28.
Ten zero 80.
080. Right. Then back to other assets. There's a prepayment on this one. Remember, given there. All right. The best way is to start afresh, so that you don't leave anything out. On other income, we have dealt with rent received in advance. Then the other expenses, there is no prepayment is there, but it's given down there. We're going to check it as we get to it. Then let's start from property, plant, and equipment. They said on 1 January 2022, BRIC sold a brick manufacturing machine for 80,000. On this date, the carrying amount, the tax base of the brick machine amounted to 420 and 360 respectively. Aibo, we made a mistake or we skipped something. Right, on 1 January 2022, we sold an asset and its carrying amount was 420 and its tax base was how much? 360. What does it mean? Remember 1 January, these are closing balance for 2021. Do you see that? If they're saying it was sold on 1 January, in 2021 it was there. 1 January is good as 31 December. So these are the balances for 2021. So let's go back to 2021 at this brick manufacturing machine. We're given the base cost and the tax and what? And the carrying amount. All right. It's matter of English there. It's brick what machine? Brick what? Machine. They said 420 and 360. Right, so giving us a difference of how much? 360, that is 40 plus 20, 60. The carrying amount of an asset is greater than its tax base, so it will give us a deferred tax liability of how much? 60,000 times 28. How much is it?
Sixteen 800.
16,
800.
80.
16,800 like this, right? We skipped this one, English skipped us there. Then right, so these assets are no longer there. Let's agree, this one is no longer there in 2022 because we sold it on 1 January 2022, which is the beginning of the year. So we no longer have it. Then they said the cost of carrying amount and tax base of remaining machines, excluding brick manufacturing machines. So we have machines plus brick manufacturing machines. The other machines, excluding bricks manufacturing machines, is how much? It's I don't know who's the thing making noise there. Right, so now we now look at the remaining machines. We are given the carrying amount and we are given the tax base. We take them as they are. We are given the carrying amount and we are given the tax base, 1485 and 1080. Machines. Machines, we said how much? 1485, 00, and 1080. Giving us a temporal difference of how much? There. Calculate it for me, please. 1,485,000 minus 1,080,000. Right, 405. Right, the carrying amount of an asset is greater than its tax base, so therefore, it will give us how much? It will give us a deferred tax liability. Yes. A deferred tax liability of how much? Kindly calculate it for me. 40500 times 28%. The tax rate is still 28%.
$113,400.
113,400. Right, thank you. We move on. We have dealt with this one. Foreign income, there's no deferred tax. Current assets, included in current assets in the statement of financial position as at 31 December is a prepaid insurance. On 1 October, Brickblock paid the insurance premium for the year of 78,000. Right, so we need to calculate the prepaid portion. On 1 October, which is 3 months before year end, we paid annual insurance of 78. So what relates to current year is how much? Is for 3 months. So a prepaid portion is for how many? 9 months. So a prepayment of how much? 78,000 times 9/12. Included in current assets in the statement of financial position of LTD as at 31 December is a prepaid insurance. On 1 October, LTD paid insurance premium for the year amounting to 78,000. So a prepayment is for 9 months. How much are you getting there? 78 times 9/12. Prepaid insurance.
58,500.
58,500. Right. the tax base will always be 0 on prepaid amount, people, on prepayment. Why? Because the tax will deduct the full amount of 78 there. Or though one will say, but there are exceptions. Let's agree that we deduct the whole amount. Right, so this is an asset. The carrying amount of an asset is greater than its tax base. So it will give us a taxable temporal difference of 58,500, giving us a deferred tax liability of how much? 58,500 times 28%.
$16,308.
16,380. Right, continue. We're here, we're on this one. Here we said dividends, not deferred tax. Taxation. On this information, people, you have to look for a situation whereby you have assessed the loss. If you have assessed the loss on taxation note, you have to look for assessed loss. In this case, we do not have assessed the loss. If we had assessed the loss, we're going to take it to the statement of financial. We're going to take it to the calculation of deferred tax. So there's no assessed loss. Right. So we're done. Let's close now. How do we close? What we are looking for here mainly is our temporal differences. How to get? Our interest is on temporal differences. Right, in 2021, how much is our temporal difference? Minus 30 plus 270 plus 60. Give me the answer. Or if you want to do it easier, I will say 270 plus 60 minus 30. The positives are greater than the negative, so we're going to have a positive answer. Positive 300. Right? Confirm.
Yes.
Because
Yes.
this will give us 2. Right. Then your deferred tax now, people. Since our temporal difference is positive, it means we're going to have a deferred tax liability of how much? Just say 300 times 28. Just say 300 times what? 28. How much is it?
84,000.
How much? 84,000.
4,000.
A liability. You can confirm by adding these numbers. Add this and this and this. If they give you minus 84, your answer is correct. So come conclude here. It's a deferred tax liability. Right? Deferred tax what? Liability.
Sorry, you said we can confirm where?
By adding your deferred tax column, 8,400 minus 75,600 minus 16,800. It should give you negative 84,000.
Okay.
Add your deferred tax asset or liability column and tell me how much you are getting.
Oh, okay. 840 minus 75,600 minus 16,800.
That's right.
84,000. Okay.
How much?
Column-
It's fine.
Column B, is it TD or TB? Text base
Temporal-
or
TB.
Yeah,
Column
temporal
2
difference.
TB.
Tax base, temporal difference, carrying
Yes.
amount. Tax base, temporal difference, deferred tax
Yes.
asset or like
Tax
Alright.
base.
tax base, temporal difference, deferred tax asset or
Temporal
liability.
difference. Carrying
temporal
amount.
difference? Yeah.
Right. We go to 2022, we do the same. Let's add minus 36,000 plus 40500 plus 58,500.
Mhm.
63,000.
How much?
63,000.
I can't be 63. Remember, this is 405000. This is 58,500. It should
Oh,
be
it's
around
double. Okay. 42300.
423,
100.
42300 like this.
427. Why am I 427?
Which one is which?
427 500.
Which one is which? You have two different answers.
Minus
No.
36,
Oh, this one is 42800. 428.
405. Ish,
Now
I
we
made
have
a
three different answers.
428.
428. We have three different answers now.
0513
Minus 3, 6, 1, 2, 3,
5
4, 0.
8500. 427 500.
427 500.
Right, let's go together. 40500 plus 58500 minus 36. Right.
427 500.
427 500. Right, it's positive, meaning it's going to give us, this is a taxable temporal difference. It to give rise to a deferred tax liability. 427 500 times 28. How much are you getting?
Double 19700.
Double 19700. Confirm others.
Yes, 119 700.
Right. If you add this column again, it should give us this answer. Right. So in other words, what is this? Conclude now. Double underline. This is a deferred tax liability. Deferred what? Tax liability. Deferred tax what? Liability. So your deferred tax for the year, you are going to say, right, your deferred tax for the year, people, is going to be a movement from this to this. From 2021 deferred tax to 2022 deferred tax. That's the deferred tax for the year. So we can simply say deferred tax for the year, it's how much? It's 119,700 minus 84,000. How much is it?
$35,700.
35,700. That's your deferred tax for the year. This is your deferred tax for the what? For the year.
For the year.
Right. Now, the question is it a deferred tax liability or it's a deferred tax asset?
Liability.
It's a liability. You moved from a negative number to a negative number. It's a liability. How would you get? Or if you want to understand it better, just apply your common maths. Remember, we're saying negative 119. Remember, the distance between point B and A is B minus A. Let's take this as our A. This is our A. Then this is our point B. Our point B is minus 119,700. Right, minus point A. Point A is minus will give us a plus. Minus will give us a plus. So it's good as saying plus. How much? 84,000. It will give us negative 35,700, indicating that it's a what? It's a deferred tax liability. If you wanted to do it this way, but you can ignore the signs since they are the same. You ignore the signs, then you conclude that it's a deferred tax what? Liability. Since we moved from a negative to a negative. Negative small number to a negative bigger number, so it's negative. Right, but note that our interest is on movement in temporal difference. The reason why we did this, we wanted this amount. We wanted this what? Amount. How do we calculate movement in temporal difference? We are going to say 2022 temporal difference of 427,500 minus 2021 temporal difference of how much? Of 300,000. Note that these are taxable temporal differences. So they give us how much? 427,500 minus 300. It's how much? 127,500. So our movement in temporal difference is 127,500. Are we together?
Yes.
We go take it, we now go input it here, 127,500. 127 what? 500. Right, note that your deferred tax is calculated on movement in temporal difference. So our movement in temporal difference is how much? 127,500. It should give us this deferred tax. If we say times 28%, it should take us back to what? 35,700. That is deferred tax for the year. If you want to calculate, if you don't want to calculate your deferred tax on that method of saying the movement, you can just calculate your movement in temporal difference, then get the movement times 28%. Should give you the same answer, 35,500, 35,700.
700, yeah.
Right, now we have a movement in temporal difference of 127,500. What did you say by this one, by the way? Are we adding or subtracting? Right, that's where the issue is. Are we adding this or subtracting this? We all agree that this is a taxable temporal difference. Taxable, it will result to a taxable temporal difference will result to a liability in future. So what do? Do we deduct or do we edit? Anyone?
Deduct.
Deduct negative.
We
We
subtract.
deduct. Right, we deduct. Right, let me take you to your study guide so that you won't have a problem when it comes to this one. Students struggle on how to treat this. Where's that study guide? Where is that study guide? This one. Right. You see that story where we're saying when this is greater than this, this is greater than this.
Yes.
Temporal difference. Where is that summary of this one?
Setting amount.
What's the summary? I remember explaining it last time.
There on top, you just pass it. I think I saw something here. Isn't this one? There you go.
Page 7.
Page 7.
Yeah, I think it's page 7.
Right, there is where they summarize and say this one you add it to profit and this one you deduct it. That's what they want. Right, deductible temporal difference result in amount deductible in determining taxable profit or tax loss. Right, ours is what? Ours is taxable, né? Ours was positive, né?
Yes.
So giving us deferred tax liability. What are they saying here? Deductible temporal differences are temporal that will result in amount that are deductible in determining the taxable profit of future periods with the carrying amount. This happens when that's not the part. To match future tax expenses with the common, we have to debit further tax expenses. That's not the part I'm looking for. Deferred, an increase in deferred tax. Why is that summary now?
What are we looking for, sir?
Right, we're looking for a part where they give us the treatment of deductible temporal difference and taxable temporal difference. We want their treatment when it comes to adjustment of profit before tax. What did we do with deductible temporal difference? Do we add it or do we subtract it? That's what we're looking for. That's what we are looking for.
We should understand the following order determine whether the term movement temporal from one or detectable.
All right, temporal difference. All right, it's fine. You look for it on your own. But just know that if it is taxable, yeah? If it is a taxable temporal difference, you deduct it. If it is a deductible temporal difference, you add it. Yeah? Taxable deduct, then deductible add. Let's hope.
You're not confusing them. Because I think
That's
the
why I was
last time we said deductible is and
That's why I was
taxable, that's the one that's positive.
That's what I was trying to establish by checking that. I've forgotten the page where it's right. Anyone with access to Telegram, go to
Homework.
anyone with access to Telegram, go to FAC3701 and look for the solution for this assignment. Right, for now, this is. We said it's, let's go back to the solution. We moved from 300 to 427, eh?
Yes.
We moved from 300 to 427, and our difference is positive. So if it is positive, you subtract it. If it is positive, it simply means that it will give rise to a deferred tax liability. It's fine. Right, I know it's fine. Right, so and now we're going to say 80, 10, 160 minus 127, 500, giving us taxable income of how much? Taxable income 80, 10, 160 minus 127, 500.
Um, 78, 82, 660.
660. This is our taxable income, double underline. Calculate your current tax on it. Current tax at what? 28%. 28% of this, how much is it?
28% of what?
Of your taxable income. 28% of 7882660.
I think it's 2207 144.8.
2207 148.
144.
All right, fine. We have managed to calculate our taxable income, so we calculate current tax on taxable income. Out again. We have calculated our current tax as 2207,148, and we have calculated our deferred tax here as what? As 35700. né? Deferred tax is you calculate it on movement. That is 2021 deferred tax and 2022 deferred tax. We just said 2022 deferred tax minus 2021 deferred tax. That's how we do it. Any questions, people? You now know how to calculate current tax and deferred tax. You can now attempt any question. Anyone with a question?
Can you just scroll up? I just want to check what's the answer for the current tax at 28%.
All right, the current tax, 28% of taxable income.
So it's not 145 because it's 2207 144.80. It's not.
Oh, it's 5. All right, it's fine. Yeah, it's 5.
Mm.
All right. That's how we calculate current tax and deferred tax. You should be in a position of attempting any question to do with this.
I think we are.
You are almost there. All right. So
Yeah.
next week we are going to look at dividends. We are going to look at provisional tax, and we are going to look at assessed loss, right? This won't take us even 10 minutes, these three. Then after that, we'll look at disclosure. All right, we look at disclosure. Remember, today the required was disclose. Are we together? The required is saying disclose what? The required is saying disclose the income tax note. We did not disclose. For us to disclose, we need to first calculate our current tax and our deferred tax. Are we together? So it disclosure will be a matter of me giving you the framework. Then the answers you get them from that, from the calculation of current tax and deferred tax. Or what I'll do is I'll share the recording on disclosure. So you go through the recording during the week. We meet next week. We just spend 30 minutes or less on it. Are we together? Or what you do is we'll continue with this question next week and do it disclosure. We have all the workings now. So what you do is we do the disclosure. I'll share the recording on disclosure. I will disclose. Then you try to find time to go through it during the week. Then after that, you simply say we're done with IAS 12. We'll move on to the next topic.
Let's call it a night.
We have class tomorrow.
Right.
No.
Not tomorrow, we don't have, no?
Oh, okay.
Don't have pressure
Thank
now.
you.